Homebuyers are freaking out right now and they're canceling contracts at record rates. Now I'm talking particularly about canceling a contract to buy a home they're currently in escrow on, because as mortgage rates remain high and prices continue to decline, buyers are not only getting priced out of the market, but they're also getting very nervous about buying at this stage in the market where they're very likely to lose equity right after they close on the home. So naturally, builders are feeling this pain as they're currently in a position where they really need to offload their inventory. They continue to slash prices and up the incentives they're offering home buyers, but in addition to that, they're also reducing the amount of homes they're building now. All of this as we dive further into this economic and housing recession, so lots to talk about in today's video. But before I get started, do me a favor and support the channel by smashing that like button, and if you haven't already done so, definitely subscribe and hit that notification bell to watch more content like this. And with that said, let's jump into it. Homebuyers are canceling contracts at the highest rate we've seen since at least 2017, which is the year that Redfin started tracking the statistic. So this essentially marks the highest rate we've ever seen recorded by Redfin, as we're currently seeing 17.9% of all homebuyers that are currently in escrow, that are currently under contract, they are canceling their contracts. If you take a look at the chart, you can see that recently it's been surging, and a big reason for that has been mortgage rates. You see, cancellations have really correlated very closely with the movement of mortgage rates. When we saw mortgage rates surge around April, May time, we also saw cancellations starting to go up. When we saw them cool down around July, August time, we saw cancellations cool down. And recently we've seen mortgage rates surge to around 7% levels as of the end of September and throughout October. And that's a big reason why we've seen these cancellations rise to the highest levels ever recorded by Redfin. Now, one of the main reasons we're seeing that mortgage rates is playing a huge role in these buyer cancellations is really tied to new construction. You see, mortgages for new home contracts are many times calculated before the home is built. And so over the time that they're building the home, if interest rates are to spike at a very fast rate, it can many times price out the home buyer from being able to afford the house anymore. Now, typically when you're building a new build, it would take you around 7 to 8 months, but with supply chain issues continuing to be an issue, it's really been taking more around 10 to 12 months. So if you were to go back around 10 to 12 months to January time this year, you could have been looking at an interest rate as low as around 3.29%. The problem is if you were looking back in January expecting that 3.29% rate, unless you locked that rate for around 360 days, then you wouldn't actually be getting that today. And so many buyers actually didn't do that because, number one, you're going to have to pay thousands of dollars in extra fees just to simply do that. And number two, not every lender even offers that option. So this has a real negative outcome for the buyers that didn't do a rate lock for 360 days that bought between January and April time, because ultimately by now the interest rates have surged more than double where they were back then. You'll see just how much it affects you with this example. If you were to buy a $500,000 home that you locked up under contract in January with 20% down, you would have been looking at a monthly payment of around $1,750 based on the mortgage rates back then. But since rates have basically doubled now, for those buyers that didn't lock in those interest rates for 360 days plus, their mortgage payment is going to be much higher now. They're going to be looking at $2,661 a month for the same price house with the same amount of down payment. That's based on 7% mortgage rates, which is roughly where we've been at for about the last month and a half, and it puts the buyer in a position to where he may not be able to qualify for the mortgage since his mortgage payment has jumped almost $1,000 a month higher, and so that forces the buyer to have to cancel the contract. So because the new builds are taking currently around 10 to 12 months to complete, those that bought houses in January through April time won't really see their houses completed until about now through around April of 2023. So this is one big reason why why we've been seeing cancellations start to surge recently. The second reason we're seeing canceled contracts is really they're getting cold feet as they start to realize that inflation is still a problem, cost of living is a concern, and ultimately they're very concerned that the house prices continue to decline. And so if they close on their house, there's a very good chance that right after they close on their house, they will continue to lose equity right away. So these cancellations particularly affect builders because, like I've been talking about on this channel for a while now, builders are in a position where they need to offload their inventory before prices continue to go down and they take bigger losses. You see, over the past couple of years, builders have been building at the highest rates we've seen since 2006. So they have a lot of inventory that they've been selling and that they need to offload off their books. So many of these homes, as more canceled contracts come through, it's only adding more inventory that these builders need to sell. So we already know that builders are currently slashing prices and upping their incentives, but now with more inventory getting added to their books that they need to offload in a market that really has some of the lowest buying demand we've seen in a while, means that we're probably going to see further discounts on prices, more incentives offered, and we're already seeing that new builds are accounting for 29% of the entire market at the moment. So you can imagine what it does to the market when 29% of the entire housing market is slashing their prices like this, and they're so incentivized to have to offload their inventory. That has a huge effect on the rest of the housing market, as other sellers, in order to be competitive, are going to have to match those prices and maybe even be more competitive. So builders ultimately know that there's rough times ahead, and so they've been trying to reduce the amount of housing starts that they've been doing. They reduced again for the month of October, as we got the reports back that housing starts were down 4.2% month over month and down 8.8% year over year. But we need to look a little bit closer at that statistics, because when you look at single family houses in particular, they're actually down 20% year over year. So I'm anticipating that those numbers will continue to decline, especially because builder sentiment levels are really at the lowest levels we've seen since 2012, as many of them already believe we're in the midst of a housing recession. We're also seeing a drop in building permits, as they went down 2.4% month over month for the month of October and down 10.1% year over year. So overall, across the board right now, production is dropping right now for builders, and what's also dropping right now across the housing market is existing home sales, as we just got the latest report back from the National Association of Realtors. Their report showed that existing home sales have drastically fallen from the beginning of the year. Back in January, we were seeing an annualized rate of around 6.5 million home sales. Now we're seeing it drop down to 4.43 million. Now this was the 9th month in a row that we saw existing home sales fall, which that in and of itself is the first time we've seen that happen since 1999. And not only that, but the amount of home sales we're seeing take place right now is at the lowest levels we've seen since December of 2011, other than a quick blip in the pandemic. Now their report also touched on the median sales price, which is obviously what everyone cares about the most, is how much home prices are actually falling as a result of this. And so what we saw with this report is, again, back in June, we were at the peak of $413,800. In September, we saw it go down to as low as $384,800. And now as of October, we hit a new low of $379,100. And so we're continuing to see the median sales price fall. So just from September to October, we saw another 1.5% drop in price. And from peak levels now, from the 413,000 all the way down to where we're at now, we're currently down over 8.4% from peak levels. And I do anticipate that, especially as November data comes out, which is going to catch up to where mortgage rates are at now, we will see further price declines. So overall, this housing market correction is really playing out as expected for the most part. I do anticipate, like I said, that prices will continue to correct to adjust to where current mortgage rates are at. But in addition to that, with all the pressure pressure on builders to offload their inventory, not to mention iBuyers and investors, which I've talked about in my previous videos. They are the forced sellers in this housing recession, and that's going to only add further downward pressure on house prices. Now, with that said, what we really need to keep our eyes on at the moment is what November inflation data comes back at. You see, if inflation continues to get optimistic reports and we continue to see it decline better than expected, then I would expect that the stock market is going to continue to rise, that we're going to continue to see treasury bond yields fall, which as a result will cause mortgage rates to continue to go down. Now, if that happens when we get the data back in December and it continues to be a trend from there on, then that will minimize the amount of price decline we see in home prices throughout 2023. But with that said, if inflation remains high, proves hard to fight, and the Fed continues to stay very aggressive in order to do that by raising interest rates, what we're going to see is mortgage rates are going to go back up again, and we're going to see bigger price declines throughout 2023. Now, this inflation data, the CPI data, comes back on December 13th, which happens to be the day before the Federal Reserve actually makes their decision on how much they want to hike interest rates. So that's exactly what we need to keep our eyes on right now, because that will ultimately play a huge role in the future of the housing market. So with that said, if you enjoyed today's video and you gained some value from it, do me a favor and support the channel by smashing that like button. And if you haven't already done so, definitely subscribe, hit that notification bell to watch more content like this. Also, let me know if you have any thoughts or questions in the comments below, and I'll do my best to get back to you. Finally, follow me on Instagram and TikTok at The Out of State Investor. And if you enjoyed this video, I'm going to highly recommend checking out one of these two videos over here. And with that said, I'll see you guys on the next one.